Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. And again this week, I'm delighted to be joined by Leah Bramwell, who is our Head of Tailored Investment Solutions from our Chief Investment Office. Welcome back.
Morning, Jane. Double header for you.
Yeah, 2 weeks on the trot. Love it. So as you know, each week on the podcast, we try to cut through the noise and demystify what's going on in the markets, just so you can feel more informed, more confident, and more in control of your financial future. So this week, Leah, I want to talk about the diversification illusion. Most of us think diversification is one of the simplest rules in investing, but what if your portfolio is far more concentrated than you realise? So this week, I'm asking that very question. Are you really as diversified as you think? And what's triggered this has stemmed from what's happening in the Korean market, which we talked about in detail a few weeks ago on the podcast. So I'd refer you back to that if you want to hear a bit more about that market. And in particular, the extraordinary rise of a couple of stocks there, which now make up a huge proportion of the Korean market. And that, I think, is just symbolic of this whole concentration risk as opposed to diversification, and really just making sure that people understand what actually is in their portfolio. So grab your coffee. Let's dive on in. Before we get into Korea and why that has triggered today's conversation, could you just help us understand a little bit more about diversification and why it's so important as an investment theme?
Yes, I think most people will be aware of the don't put too many eggs in one basket, which is your classic diversification metaphor. We often talk about football metaphors in our Canaccord office.
Yeah, well, that's because we're surrounded by boys who love football and the World Cup.
Boys, exactly. I don't think we're quite too late for a World Cup reference. So, I think it's really helpful to think about your portfolio as a team.
Yeah.
And you want some attackers and some defenders. You wouldn't put a team together which is all attacking players. Exactly, as wonderful as Harry Kane is. But you also wouldn't put together a team which is all defenders, usually. For the most part, against most opposition, you want a nice balanced team with some attack and some defence and some midfield.
Yeah.
And the same is true of an investment portfolio. You want some things which are providing that attack and some things which can protect you when things go wrong.
Okie dokie. So the difference then in terms of what we're talking about today, and in particular emerging markets, what's the difference between owning countries and owning themes for a diversification?
Yeah, so within an emerging market bucket, you have a very strong exposure to a particular theme. So whilst you have exposure to lots of different countries, you might also have exposure to the same theme which appears across different countries. So you need to be aware of what is underlying the index or the country that you're thinking about investing in.
So when investors hear emerging markets, what is it they think they're buying?
So usually people are aware that emerging markets span the economies which don't make up the developed market indices. So the most commonly understood and held emerging markets would be China, India, Taiwan, South Korea, Brazil. Those are the five most well known. But actually, there's a whole world of emerging markets, and below emerging market are frontier markets.
Frontier markets,
nice. Which have stock markets and investable companies, but don't quite make up the emerging market status yet.
So developed, emerging, and frontiers. Okay, so the Korean market, where would that sit?
That is firmly in the emerging market bucket and is one of the largest emerging markets.
So let's have a little look at that in a bit more detail, and particularly the two equities that we talked about a few weeks ago, and what's happening there.
Yeah, so there's two semiconductor companies within the South Korean market, Samsung Electronics and SK Hynix. And those have had phenomenal runs year to date. And at a point in time, those two companies made up more than 50% of the South Korean index.
Yeah.
Now, there has been a fairly sharp pullback over recent weeks, but so that weighting has come down, but it's still significant within the context of the index.
So I guess also if you've got you own a Korean fund or an emerging market fund, you're heavily reliant on those two companies as part of. holding.
Exactly right. So you're very exposed to that theme, particularly if you're holding a specific Korean tracker, but also within an emerging market tracker, because within emerging markets, more than 75% of an emerging market index is made up of the top 4 emerging markets. So that would include South Korea, Taiwan, China, and India.
So not diversified at all then?
Not particularly diversified.
Okay. So most people, I think, assume that if they hold an emerging market fund, it will give them broad exposure to growing economies around the world. But increasingly then, from what you've just said, they are buying actually into the global AI story rather than the local economic growth story.
Yes, exactly. And not all indices are made equal. And I think it's worth bearing in mind also that this applies to a global index as well. You know, if you hear a global index, you think, well, I'm getting exposure to the global equity market. But actually, that's heavily concentrated both in the US and within the US in the very large companies that make up the US index. So this isn't an EM specific phenomenon. This is the challenge with passive investment, which is those indices,
tracker funds, index tracker funds.
Exactly. So you just need to be aware of what's making up.
So you need to really know exactly which index you're tracking, and therefore what is in your portfolio beneath the surface.
Exactly.
Yep. Okay, I understand. So what other markets then might be more interesting in maybe in the emerging market space that are perhaps uncorrelated with AI? Because AI is the concentration risk, I think, is what we're talking about, isn't it?
Yes, exactly. So your AI concentration risk, you're trying to look for something that you're not getting from a global or a US market tracker.
Yeah.
That most people, when they're investing in emerging markets, that's what they want. And there are lots of markets that will provide that on the smaller end of the emerging market scale or the larger end of the frontier markets. So markets such as the Philippines, Kenya, Vietnam, Indonesia, South Africa, even India, which is a very large emerging market, has relatively little exposure to that theme.
Okay, thank you. And if someone listening does own an index or tracker fund, what are the 2 or 3 things they should check to understand what they're really invested in?
So your first thing to check is what the companies underlying that index, what they are.
Okay.
And also to make sure that if you're owning multiple trackers, like a US tracker and a global tracker, that you're aware that there's a very high level of crossover between those 2 trackers. So be aware of what's underlying your holdings. And beyond that, be aware of the themes.
Yeah.
So if you've got a Korean market tracker and a US market tracker, be aware that
you're going to be heavy.
You're going to be very heavy in semiconductors.
Semiconductors.
So I'm not saying at all that you don't want to have exposure to those areas. It's prudent to have some exposure to those areas, but you want to be aware of how much you have.
Yeah.
And we talked about it a bit last week, didn't we? That markets can be very volatile and on noise. And this week the noise is around worries about the capex, the capital expenditure plans of these AI companies, and markets are wobbling. And the risk is if you have too much exposure to that particular theme, you see your portfolio go down maybe more than you expected it would. And then you make bad decisions because you're panicking or you're fearful that those behavioural biases come in once again.
Yeah, understood. So just thinking about emerging markets, what role should they play in a long-term portfolio then?
So emerging markets make up over half of the world's population.
Yeah, okay.
And
so huge markets.
A huge market in demographic terms,
Yeah.
and nearly half of the world's GDP. And that has risen quite dramatically in recent decades. But they still make up only about 10% of global equity markets.
Okay.
I think that's a really interesting dynamic. There's a really powerful demographic and economic factors at play, and that has been the case for many years, even decades. But I think if we're looking forward 30, 50 years, if you're looking at a child's portfolio, for my young children, tech is absolutely a theme that I want to play, but EM is also very, very high on the list. If you look at how you think the world is going to change over future decades, not 1, 3, 5 years, but future decades, I think emerging markets are really, really important exposure to have in this long term.
Presumably accepting that they're going to be a bit riskier, a bit more volatile. So it is a long term investment.
Exactly. And I think that means that you should be very careful about how you're exposing yourself to that, and really look for managers that have proven track records and expertise investing in emerging markets. And there are a lot of those, and it's possible to outperform for active managers in emerging markets in a way that's been really difficult in the US in particular in recent years.
And presumably you and the team are busy finding those fund managers for clients all the time.
Absolutely.
Yeah, great. Thank you very much. Let me sum up what is in my Canaccord takeaway coffee cup today. That's quite a lot in there, actually. Quite a lot of emerging markets. We talked about the diversification illusion, and that fund labels perhaps don't tell the whole story. And you think you're in an emerging market fund, but actually you might be in a global AI fund, really. And therefore, diversification isn't just about how many countries you own or think you own. It's really about how many different drivers of return you own beneath the surface. Yeah, very interesting. I think I might need to go and look at what funds I'm in. Thank you for listening to the Coffee Break podcast today. We hope you've enjoyed it. Don't forget to hit follow on your preferred podcast channel of choice so that you never miss an episode. And as always, we'd love to hear your thoughts. Drop us an email, coffeebreak@canaccord.com. Thank you.
Thank you, Jane.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.